In this presentation, I will explain ways you can invest on the Ethereum blockchain. Here you see the table of contents of this presentation. First, I will explain ways you can invest on the blockchain. I will not give investment advice. In the second slide, I will explain what fungible tokens are. In the third slide, I will explain a special kind of fungible tokens called the stablecoins. In the fourth slide, I will explain what liquidity pools are. This is how most fungible tokens are traded on the Ethereum blockchain. In the fifth slide, I will explain a problem with liquidity pools called impermanent loss. In the sixth slide, I will explain what non-fungible tokens are. And in the last slide, I will explain how you can invest in Ether, the native currency of the Ethereum blockchain. So first, I'm not going to give investment advice. I just want to explain possibilities that exist, just to make it clearer, because there are a lot of scams and I want you to be informed. Be aware that there are a lot of scams. Be aware that everyone who wants to can create tokens, whether it be fungible tokens or non-fungible tokens. It doesn't mean that these tokens have values. Tokens only have value if they are properly backed, and it is up to you to find that out. Fungible tokens were introduced in November 2015 by the Ethereum standard ERC20. In fungible tokens, every token is interchangeable with each other, and this is used for cryptocurrencies. Most of the trading happens on uniswap.org, where you see the website there. The special kind of fungible tokens are stablecoins. These are tokens that are pegged to a real-world currency. The most popular or most used stablecoins are pegged to the dollar. The three biggest are USDT, USDC, and DAI. And you also have some stable coins pegged to the euro, like Stasis Euro, EURC, and EURT. USDT and EURT are backed by a company called Tether, which is incorporated in the British Virgin Islands. The USDC and EURC are backed by a company called Circle, which is from the United States. DAI is backed by a decentralized autonomous organization on the blockchain called MakerDAO. Binance USD is a token that is backed by Binance, the biggest exchange on the world for cryptocurrencies, where it's not really clear where they are incorporated. And Stasis Euro is backed by a company that is based in Malta. You also have pegs to other real-world currencies like the Brazilian real, the Chinese renminbi, the Japanese yen, the Swiss franc, and the Turkish lira, though these stablecoins are much smaller and I don't know how reliable they are, so you have to look that up for yourself. I also want to warn about the case of Terra, which is a stablecoin that was pegged to the US dollar and that collapsed. What happened there is Terra worked together with another cryptocurrency called Luna, which was not a stablecoin, and the peg of Terra to the dollar was maintained by if the price of Terra rose above $1, then Terra was sold to buy Luna at a price of $1. If the price of Terra fell below $1, then Luna was sold at a price of $1 to buy Terra. Now, the problem was that Luna didn't have an intrinsic value. First, people gave value to Luna because they were attracted to it, because if you invested in Luna, you got 20% interest rate per year. But eventually people started mistrusting. They started selling Terra so that more Luna had to be created to buy Terra to support the price of Terra. Because more Luna was created, the price of Luna fell. Eventually the price of Luna fell so much that there was no value anymore to support the price of Terra, so Luna crashed, and then because the price of Terra could not be supported anymore, Terra also crashed, and eventually the peg was broken and all money was lost. In total, over $40 billion were gone this way. So if you buy something, any token, always check who backs it and be sure that you trust it. Now, the cryptocurrencies you see there, USDT, USDC, DAI, Binance USD, Stasis Euro, EuroC, EuroT, they have a bit of more reputable backing, but at least you have to be sure that it is something that you want to do. What is a liquidity pool? Well, to trade normally, a seller and a buyer, they meet and they agree on a price. But you had a problem on the blockchain of Ethereum that people didn't know where to meet. So people came up with the idea of creating liquidity pools, which work like this. Someone has two tokens, X and Y, and he makes both tokens somewhere available on the blockchain, and he says to other people, you can take out one token if you put in the other token. And that's a liquidity pool. And why would someone do that? It's if you put in one token and take out the other, this guy that makes his token available receives a small transaction fee. If someone makes his two tokens available on the blockchain somewhere, this person doesn't have to be there. Someone else can just come whenever he wants and just put in some money, put in the one token and take out the other token. You have some formulas to calculate a relative price of the one token in the other. Now you have some issues there in that whenever you want to buy X by selling Y in a liquidity pool, you have to send this transaction to the Ethereum blockchain. This transaction, before it comes in a block and is accepted on the blockchain, it goes somewhere in a memory pool. Other people can read your intentions. They can see that you want to buy X. They know that the price of X will go up. They can actually buy X before you do. The price of X goes up, then you buy X more expensively, and then these people sell X at a higher price. So you pay more and they profit. This is an issue related with what they call maximal extractable value of a block on the blockchain, and this is one of the issues that they try to solve with the scourge phase of the Ethereum development roadmap, as was explained in the previous presentation. Now, another problem you have with a liquidity pool, not when you want to trade but when you make your tokens available, is called an impermanent loss. First, to give you a short idea what the problem is about, you can look at the two pictures on the right. Which of the dollar notes would you prefer? Do you prefer the few dollar notes with a higher denomination, or do you prefer the more dollar notes with a lower denomination, like the 25 $1 notes or the 4 notes of $5, $10, $20 and $50? That is shortly what the problem with liquidity pools is. If you create a pool or you join a pool for making tokens available, what typically will happen is that the token that is undervalued in the pool will be taken out and the token that is overvalued will be put in. You will get more of the undervalued token, but the total value of what you have put in will decrease. I also have numbers to explain how it works. Normally, if you have two tokens in a liquidity pool, a simple formula that I often use is that the multiplication of the amount of both tokens is constant and the relative price of both tokens is equal to the ratio of both tokens. So if the multiplication of the amount of both tokens will be 40,000 and the price of both tokens would be the same, then you would have 200 of each tokens. Why? Because 200 multiplied by 200 is 40,000 and 200 divided by 200 is 1. If one token is 4 times as expensive as the other, then you would have 100 of the more expensive token and 400 of the less expensive token in the liquidity pool. Why? Because 100 multiplied by 400 is again 40,000 and 400 divided by 100 is 4. If you join a liquidity pool with a price of X equal to Y, but the real value of X is 4 times Y, then you would put in 200X and 200Y, and people will take out X because X is more valuable and put in Y because Y is less valuable, and you will be left with 100X and 400Y. So if you want then to take out your share on the liquidity pool, you will be left with 100X and 400Y. Why would you lose then? That is because the initial thing you put in the liquidity pool is 200X and 200Y, which has a total value of 100Y or 250X, and what you are left with is 100X and 400Y, which has a total value of 800Y or 200X. So you would lose 200Y or 50X. This loss is permanent. So they call it impermanent loss, which I think is a misnomer. They call it impermanent because if the value fluctuation between X and Y is temporary, then the loss disappears. So if X and Y become as valuable as each other again, then the loss disappears. But as long as the change in value between X and Y is permanent, the loss is also permanent. What are non-fungible tokens? As opposed to fungible tokens, you have non-fungible tokens. Non-fungible tokens are unique. Like each token is different from the other. You cannot interchange them with each other. The standard for this has been introduced in January 2018, and the name of the standard is ERC 721. As an example, you can see the images of the kittens on the right. Each kitten is different. This is typically used for collectibles. And the biggest marketplace for NFTs is OpenSea.io. You can create your own NFTs there and you can trade them for free. If someone asks you to pay money to trade something there, it's a scam. So you can trade there, but if you create something yourself, you can trade it for free. I also included a graph there of the price of Ether and Bitcoin over time, and you can clearly see where the first NFT was launched on the Ethereum blockchain. This was called CryptoKitties, so you can clearly see a price hike there. It became very popular, so popular that it actually congested the Ethereum network and it drove up the transaction prices. In the end, what they actually did is, because it became too expensive to run CryptoKitties on the Ethereum blockchain, they just switched to another blockchain. So CryptoKitties still exists, but it's not traded much on the Ethereum blockchain anymore. It's more traded on another blockchain, which is cheaper. What is CryptoKitties about? It's just a game where you can buy a kitten which has some genetic properties, and you can have multiple kitties mate with each other, and then they get children, and then they inherit genetic properties from their parents at random, so you can create other kitties, and then you can try to have kitties which have rare genetic properties. It's about that. It's a game. People liked to play it, it was a hype, and then it actually congested the whole Ethereum blockchain at a certain moment. After that, in the 2000s till the beginning of 2002, you had another NFT hype, which you can also see on the graph. And since the beginning of 2022, well, the hype declined. What you also can see on the graph is where Terra, which I spoke about before in this presentation, crashed and $40 billion disappeared. Finally, you can also invest in Ether, which is the native cryptocurrency of the Ethereum blockchain. Nowadays, Ether is deflationary, which means that the supply of Ether decreases over time. And if you believe that the value of the total supply of Ether would not decrease over time, then if you buy Ether, value of Ether would rise. The website Ultrasound Money wants to show that Ether is deflationary. Why did they come up with the name Ultrasound? It is because Bitcoin has been called sound money. Bitcoin is called sound money because the supply of Bitcoin is limited to 21 million Bitcoins, as opposed to currency where the supply is not limited, and some currencies, they have a high inflation because the supply increases over time. So Bitcoin is not inflationary, and because Ethereum doesn't have a limited supply, but the supply even decreases, they call it ultrasound. Why does the supply of Ethereum decrease? That is because Ethers are burned in transaction fees. In one hand, the supply of Ether increases because Ether are used to reward validators. Validators receive Ethers, and for this they have to create Ether. But the amount of Ether that are burned in transaction fees is higher than the amount of Ether that is handed out to validators. In a normal situation, this is not always the case, but usually it is. Not all Ether that are paid in transaction fees are burned. It is only the Ether that is paid in the base transaction fees. So each block on the Ethereum blockchain has a minimal gas price. Why is that? It is just to limit the traffic on the Ethereum blockchain, to make sure that there are not too many transactions on the Ethereum blockchain. If the Ethereum blockchain is congested, the minimum gas price goes up. If the network can process much more transactions, the minimum gas price goes down. It is this minimum gas price that is burned. Everything you pay above this minimum gas price is paid out to the validator who puts the block on the blockchain. You can decide to hold Ether and let its value increase if you think that the value of Ethereum will increase over time. But you can also earn interest on your Ether on top of that. One way to earn interest is by becoming a validator. Then you have to stake money and run the hardware for being a validator node. Another way is just buying Ether and lending out your Ether to people who want to be a validator. One website through which you can do this is rocketpool.net. In rocketpool.net, then, because you lend out your Ether, the stakers that use your Ether, they make you share in the rewards and you get interest payments as well, which you can see on the website how high they are. Now, the amount of interest that you receive by staking Ether or by lending out your Ether through a pool is variable. The formula that calculates how much interest you receive is proportional to the formula you see on the slide, 16 times the size of your stake divided by the square root of the total size of all stakes. If you increase your stake by a certain amount, the rewards you get increase by the same amount, but relatively you get the same interest rate. The interest rate only changes if the total amount of all stakes varies. So if the total amount of all stakes goes down, the interest rate goes up. If the total amount of all stakes goes up, the total interest rate goes down. You can look up what the current interest rate is by entering in Google APR Ethereum. And you will find some websites that show you. When about 20% of all the Ether supply is staked, the APR is above 4%. And then you can more or less, from the formula above, you can calculate what would be the lowest theoretical interest rate you could get in case all the supply of Ether would be staked, and then it would be above 1.85%. I have not found the exact interest rate that you get when all the Ether is staked, so I do not know what the exact number is of the lowest interest rate you would get if you stake your Ether, but from calculations I see it would be above 1.85%. At this moment, about 20% of the supply of Ether is staked, and the interest rate that is paid out is around 4.2%.